Today, we're expanding our lens with a detailed review of the global hydrogen sector's retrenchment. We analyze Thyssenkrupp Nucera's exit from U.S. green hydrogen megaprojects, dig into oilprice.com's acerbic but reasoned critique, explore why this moment offers a critical opportunity for market maturity, and, new for today, break down the real risks that come from overinvesting in hydrogen projects that are, at best, unfeasible. Let's dive in and bring you the data. Thyssenkrupp Nucera's recent move to abandon its U.S. green hydrogen pipeline reverberates throughout the industry. CEO Werner Panikwar confirmed that late-stage projects, especially those not already at the shovel-ready phase, are no longer feasible after critical clean energy tax credits in the U.S. were scaled back by the current administration. The new rules mean only hydrogen projects initiated before 2027 will benefit from the now limited support, leaving a swath of planned developments unfunded or unattractive for capital. Nucera's pivot isn't an isolated trend. Throughout North America, developers have responded to changing policy by shelving over $10 billion in hydrogen infrastructure over just the last 18 months. Even projects that remain possible are now subject to stricter commercial scrutiny. Strong offtake agreements, integrated demand, and local market incentives are prerequisites. Panikwar stressed that the company remains committed to hydrogen, but the playing field now requires discipline. This is a shift from a build it and they will come to build only where you know they're coming. The result, a much more sober, cost-driven market. One less driven by optimism and more by the business fundamentals of utility, margin, and risk. In the second segment today, the essay from oilprice.com captures the story succinctly. Most of the frenzied build-out since 2020 has not translated into durable scaled hydrogen adoption. The real numbers are illuminating. Globally, under 1 million tons of low-carbon hydrogen are actually utilized today, against 97 million tons of overall demand, and with just over 20 gigawatts of real electrolysis capacity built or bankable. Europe, which led the green hydrogen charge, has only 3 gigawatts in final investment decision, enough for about 415,000 tons per year, not remotely close to the replacing fossil-derived hydrogen at scale. Blue hydrogen, expected to fill that gap, is also seeing contraction. While some projects remain in play, more than 1.4 million tons per year worth have been shelved due to economics, regulatory uncertainty, or infrastructure bottlenecks. Few developers, investors, or off-takers want to commit billions unless there's clear profitability in sight. The key takeaway, this collapse in hype is healthy. It means only projects with real offtake, credible integration, and competitive costs will move forward. As markets shift from headlines to bankable economics, the sector is finding out the hard way that only certain applications are worth targeting. The rest will fade without further wasted investment. And so, why is losing hydrogen hype a critical opportunity? Market discipline is giving hydrogen space to breathe and mature. The sector's true value isn't as a universal panacea, but as the critical piece in applications where direct electrification hits a hard wall. Think ammonia, methanol, heavy refining, steel, high-temperature process heat, grid backup, marine fuels, and some forms of long-haul transport. Globally recognized research shows hydrogen's use for passenger vehicles and home heating is not just inferior, it's often economically unjustifiable, with efficiency losses at every step. Instead, smart investors and policymakers are now zeroing in on clustered use cases: industrial zones, major seaports, regional fertilizer producers, steel mills, and renewable backup sites. These are places where scale, logistics, and existing demand combine to make hydrogen investment both rational and resilient, and long-term strategic value can grow. This reorientation trims the sector down to fit the contours of markets where hydrogen is truly efficient, bankable, and irreplaceable. And so it's tempting, especially for governments and headline-chasing investors, to double down on ambitious hydrogen visions. But unchecked overinvestment carries real risks. First, sunk costs and stranded assets. Recent cancellations illustrate that billion-dollar electrolyzer projects, port terminals, and supply corridors with no guaranteed offtake or regulatory certainty can turn into stranded assets. Estimates from major financial houses suggest up to $12 billion in global write-downs for hydrogen infrastructure just in 2025. Second, regulatory risk and policy whiplash. Rapidly shifting subsidies and tax regimes have left developers scrambling. When policies expire, as in the U.S. post-2026, late-stage projects collapse, undermining industry credibility and investor confidence. Third, market distortions and capital misallocation. Overinvested markets drive up the price of components, labor, and land for everyone, including profitable projects. If more than half of the sector's capital is chasing non-viable ventures, it can crowd out funding from genuinely impactful, economically grounded hydrogen applications. Fourth, public trust and reputational damage. If highly publicized hydrogen ambitions repeatedly underdeliver, both political and public trust erode. This can slow adoption in high-need areas, stranding not just assets, but political will itself. And finally, opportunity costs. Every billion diverted to unfeasible hydrogen projects is a billion not invested in proven decarbonization. Think grid upgrades, electrification, renewables, transmission, and critical minerals, which are often more efficient and have more rapid impact. The way forward is through discipline. Focus investment where hydrogen has enduring economic justification and strategic importance right now. Industrial clusters, steel, fertilizer hubs, grid-scale backup, renewables integration, shipping, and long-haul heavy transport. These are the sectors that benefit most. Countries and companies that resist hype and instead plan, finance, and deploy hydrogen in these high-impact zones will create the conditions for long-term industry growth and climate progress. All right, that's it for me, everyone. If you have a second, I would really appreciate it if you could leave a good review on whatever platform it is that you listen to. Apple Podcasts, Spotify, Google, YouTube, whatever it is. That would be a tremendous help to the show. And as always, if you ever have any feedback, you're welcome to email me directly at info@thehydrogenpodcast.com. So until next time, keep your eyes up and honor one another.